Hi everyone. Today I want to continue to talk about mortgages, specifically about the impact of making additional payments on mortgage principal on a 30-year fixed rate mortgage. Paying additional on your mortgage principal is an effective way to shorten your mortgage length and provides a guaranteed investment, and I believe is part of an overall diversified and balanced portfolio. Now, when I say guaranteed investment, what I mean is that the guaranteed investment gain is equal to your interest rate. So if your interest rate is, say, 5%, any additional mortgage principal that you pay down is netting you a 5% guaranteed return. The reason for that is the loan repayment schedule is amortized. That is, the interest portion of each payment is based on the previous month's ending loan balance. So as you reduce the loan balance, the interest each month also reduces, and therefore the principal portion of your monthly payment increases. Now that'll happen naturally each month with your payment, but when you make additional payments on your principal, you reduce your loan balance accordingly, and you jump down on the amortization schedule, which shortens the length of your loan and immediately increases the principal payment on your normal monthly payment that much more. We're going to take a look at that here in the spreadsheet, but first, I've always viewed the monthly mortgage payment in and of itself, it increases your net worth each month. And I'm referring to the fact that each month's principal portion of the payment reduces the loan balance, which increases the equity in your home, which increases your net worth. And that, at the end of the day, is what we're trying to do. So my way of thinking is that each month's principal payment, you are taking money, say, out of your checking account pocket and putting it into your house equity pocket. You're not really paying the bank per se, you're paying yourself, because you own a little bit more of your house each month and the bank owns a little less. Of course, the interest payment goes to the bank, and that's what you're paying them to provide you with a loan in the first place. So any reduction in the principal is a guaranteed investment, like I mentioned. I want to show you that now in the spreadsheet here. First, I just want to go down to the amortization, which I was referring to. And if we have a $270,000 mortgage, let's say 30-year fixed rate, a 30-year fixed length at 5% rate, and we can plug any numbers we want in here. That's what I just have pre-populated. But just to show you the interest and principal portions of that payment. So the monthly payment is $1,449. You can see it starts out in month one, first payment you make, how much principal and how much interest. And then, of course, the principal reduces your ending loan balance. Not a lot of principal here and a lot of interest. So if we can, we would like to try to move down this amortization schedule because there's 360 monthly payments, right, for 30 years. So if you do have extra money each month, for example, let's say you get a raise and it's, I don't know, $250 a month, putting in an extra $50 a month to your mortgage principal will move you down the amortization schedule. Maybe not all that fast, but it gets the ball rolling, and that, again, that's a guaranteed investment because you're moving down on the amortization schedule, which means you're paying more principal each month. Of course, if you get a lump sum bonus or some other type of lump sum, that really moves you down the schedule pretty quickly. So that's my main focus here when I'm managing my mortgage, is to reduce the interest portion as quickly as I can, because that's a lot of interest and I hate paying that to the bank. Don't tell them that. So basically, the way you can see how quickly you move down the amortization schedule is based on your mortgage amount and interest rate. Monthly payment of $1,449 in this example, and by the way, we're over 30 years, we're paying not only the $270,000 we owe to the bank, we're paying them an extra $251,000 in interest. And you can see I'm going to just change this to say 6%, so we're at 250, call it 252. up to 312, 313 by 1% interest rate. So it goes back to what I was saying in the previous video. Do everything you can to get a lower rate. Let's just change that back to 5. And as I mentioned, let's say you add $50 a month. And I just have this based on years, not months. So there's 30 years. And let's say after year 2, you get that raise at work and you're able to add 50 a month. And that totals up to 600 a year. So I'm going to scroll down into the amortization schedule. And basically at the end of year 2, you would have been having a loan balance of $261,829. You've added $600, and now you're down. The new loan balance is $261,229. Not tremendous, but again, that's $600 investment you've made in your home. So your next payment now is not based on this loan balance. That's the old loan balance. It's based on the new loan balance. So you're skipping down in the amortization schedule a couple of months here because it's not exact, and the bank has a way of figuring out exactly. But so you've jumped down a couple months. Your next month's payment will be based. The payment always stay the same, but the interest portion will be based on the new ending loan balance here. So you've effectively increased your principal you're paying next month and all months after that, and reducing your interest. Now, where you really see the bang for your buck is, let's just say instead of 600, you're able to do 6,000 at the end of year 2. Scroll back down here. So instead of being at 261,800 on month 24, you're now jumped to 255,829. Let's scroll down here on the amortization schedule to get to 255,829. Way down here, kind of down in month 40, closest one, right? So you've jumped 16 months. You've taken 16 months off of your mortgage, the length. So it's not 30 years anymore. You effectively have reduced that. So that's exactly, if you can, it's not easy to do that, obviously, but the more you can add each month to your principal, the better, whether that's in a lump sum or a little bit at a time each month. Thanks for watching. Please sub up and or give me a like if you liked what you heard today, and we'll talk soon. Take care.